Welcome to another edition of Taking Stock for the week ending the 16th of May 2025. I'm Kien, Trinh, Head of Research at Stock Doctor, and joining me today is our Senior Portfolio Manager, Matthew Swartz, to stream to you all things share market. How are you, Matt?
I'm very well, thanks, Ken. It's good to be approaching the end of the week.
Yeah, it's been pretty crazy. We're in mid-May at the moment, and it's the middle of confession season. So, we're starting to see a few companies release updates, and some of them were negative surprises. But we'll touch on that later. But before we get started, just a quick yet important reminder that the information we provide today is of a generic nature and shouldn't be taken as personal advice. Remember, shares are volatile, so past performance figures shouldn't be relied upon as a guide for future performance. Well, what a positive week this week, Matt. The all odds, it surged early in the week as the US and China agreed to a 90-day tariff truce, and that triggered a global relief rally. Iron ore prices rebounded on hopes of a renewed Chinese demand, lifting miners like BHP and Rio Tinto. Meanwhile, you had optimism around global growth and signs of US tightening supply, and that led to rising oil prices as well. And that boosted Woodside Energy and Santos.
Yeah, that Trump backflip certainly put some fuel under the tech stocks, which rebounded in the Australian market as well as clearly the US market this week, with WiseTech, Pro Medicus, and Technology One gaining on renewed appetite for these high growth names. Also, accounting software provider Xero performed well after announcing a 23% rise in its revenue and a 6% uplift in subscriber growth, which was broadly in line with market expectations.
Yeah, those were positive results, Matt. But aside from that, we had Aristocrat. They slid after a revenue miss, while Commonwealth Bank, they managed to post modest gains after posting a quarterly update in line with expectations. So banks remain in the spotlight, with the market questioning whether their high valuations are justified, especially following a pretty ordinary reporting season.
And meanwhile, healthcare and pharma stocks face renewed selling pressure after the US signaled fresh scrutiny on global drug pricing. However, stocks in the sector like CSL, Neuren, and Telix Pharmaceuticals eventually recovered after a sell-off earlier in the week.
Yeah, and moving forward, Matt, I think the RBA, they are expected to cut interest rates next week when they meet on Tuesday, which in turn is positive for equities. However, the strong jobs data that came out this week and also the trade truce between China and the US, that is prompting money markets to dial back their number of rate cuts in Australia to about 3 by the end of the year. So that's a key risk to watch out for moving forward. Let's turn our attention to a few star stock highlights for the week. First off the rank is Aristocrat Leisure. They reported a 6% rise in normalized earnings for the first half and did indicate that their gaming unit, it continues to gain market share, while its social casino franchises, they continue to outperform the market. So why was it sold down so severely following the result?
Yeah, pretty good question. Look, despite the headline earnings growing 6%, the result did fall short of what I sort of consider lofty expectations. And that miss was driven by softer than expected performance in its gaming ops division. Specifically, the average daily fee per machine in North America dropped 5% year on year, missing estimates and negatively impacting its earnings. And that fee per day is a key metric for Aristocrat, and it essentially refers to the average amount of revenue Aristocrat earns per gaming machine per day when those machines are leased to casinos rather than sold outright to them.
Yeah, I see. Despite this, though, the business continues to forecast positive earnings growth for the full year on a constant currency basis. And on top of that, you have the share buyback, but there is also the prospect of further M&A activity, with speculation that Aristocrat may be interested in purchasing electronic table gaming company Interblock, but we'll see what happens there. So perhaps this volatility could create some opportunity for those long-term investors. And moving now towards the bank sector, Matt, Commonwealth Bank, arguably the highest quality bank in Australia, they released their third quarter update, and the bank is currently on a gross dividend yield of only around 4%. So what was the most interesting feature of this update?
Well, the standout feature of CBA's third quarter 25 update was its resilient earnings performance, with cash profit rising 6% year on year, despite what many consider a challenging economic backdrop. Particularly notable was the 9.1% surge in business lending, which was well above system growth, signalling strong momentum in commercial credit across sectors like infrastructure, healthcare, and logistics. In addition, the core of its profitability, net interest margins remained stable at 2.08%, and this should continue to help sustain its dividend for the year ahead. CBA has the largest market share in household deposits, home loans, and business deposits among Australia's major banks, but the stock continues to trade well above fair value under Golden Rule 5. So I guess the question, Ken, on everyone's mind is this premium justified? Are we going to expect a pullback at some point?
Yeah, I think we just need to be careful when relying on consensus price targets under Golden Rule 5 because these are subjective measures and they are based on analyst modeling, which uses various cash flow and economic assumptions, which constantly change over time. However, looking at valuation more objectively, though, we can see that the stock is trading at a dividend yield well below its historical average of around 6%. And this premium, it is hard to justify, and it assumes a near perfect economic environment for the year ahead. But that said, though, the bank's earnings track record, it's got quite stable interest margins, and it's a market leader in digital platform, and it's got quite a defensive balance sheet that warrants a premium over its peers at the moment.
Yeah, well said, Ken. I think this one's going to be debated well into the year. And looking ahead with the corporate calendar, we can see that Technology One is expected to release its results next week. Xero has already reported its full year results, which was in line with expectations, but we'll take you through our analysis on that next week.
Yeah, it's currently under review. And just a quick mention as well, we've got Treasury Wine Estates. They also made headlines this week announcing the surprise departure of CEO Tim Ford, and he's going to be replaced by industry veteran Sam Fisher as well. The market wasn't expecting this change, which adds a layer of transition risk, which we'll be monitoring quite closely over the next couple of weeks. In Under the Microscope this week, we take a closer look at animal feed business, borderline star growth stock and star income stock, Ridley Corporation. Now, they made headlines with the acquisition of Dyno Nobel's fertilizer distribution business. Matt, this is a significant move for Ridley. So what's the rationale behind this deal?
Yeah, very significant move. And in our opinion, is really well timed and well structured. And I think that's evidenced by the market reaction to the acquisition, where they're up about 20% post the announcement. Now, Ridley Corp has picked up Dyno Nobel's IPF distribution business at what we'd call a bargain price. The key point here is that they've acquired a strategically adjacent operation with good market positioning while avoiding the more capital intensive and environmentally risky assets which Dyno Nobel has kept.
Yeah, it sounds like Ridley's bought the good bits and left the rest, but it looks like they've also paid a low earnings multiple for a business they believe they can run better. Plus, it complements Ridley's core operations, allowing for synergy in the distribution, also capital efficiencies through simplification, and potentially improve working capital management. But some investors might be worried about Dyno Nobel's own financial issues, specifically with their poor financial health standing. Should they be?
Look, it'd be a good question if they were buying Dyno Nobel, but they're only buying part of the business. So it's not particularly relevant here. While it's true that DNL is early warning for financial health, the deal structure ensures that those risks don't transfer over. Ridley is only taking on the assets that make strategic sense, and the increase in gearing is only modest, from 0.52 times to 0.57 times in total liabilities to assets, and debt remains comfortable at 1.3 times cash operating earnings.
Yeah, I understand that there'll be a dilution effect and a drop in return on equity for financial year 25, but this seems to be more than offset by what's expected to be double-digit earnings accretion in financial year 26 and beyond. And post the acquisition, the IPF distribution business, that's forecast to contribute to around 45% of earnings, which is quite a material pickup. But the fertilizer business is dependent on commodity prices, which are inherently more volatile. Will this impact Ridley's stable dividend profile?
Yeah, look, it could introduce some variability given the fertilizer business is more exposed to commodity price swings. However, Ridley's broader diversification helps smooth that out. And more importantly, both Ridley and the IPF business hold strong local market positions, which gives them pricing power and cost advantages. So we're confident that the dividend remains sustainable at close to 5%.
Yeah, and it looks like the market also agrees with the share price jumping following the announcement, which we believe reflects the market's recognition of the attractive pricing and also long-term value creation for shareholders.
And the good news here for investors, they can also participate in the fully underwritten entitlement offer at $2.12 per share, an absolute bargain now. And that opens up on May the 19th, one share for every 7.43 held. As I said, this is obviously a great opportunity for those invested in the stock to take up their entitlement.
Yeah, so Ridley Corp, they seem to be making a smart acquisition. They have manageable risks at the moment, and their future earnings space appears stronger despite near-term dilution. But of course, these large acquisitions don't come without risk. So really pay attention to that. And still right now, it's a Star Income and Star Borderline stock in our view. And now for question of the week. Following the Labor government's election victory, a topical question for investors is how will this impact the earnings potential across our star stocks?
Yeah, look, Labor's landslide election does usher in a period of policy stability, but it does have an ambitious reform agenda, which may have some mixed implications for our star stock universe. Now, healthcare names such as CSL, Cochlear, and ResMed may benefit from Labor's $8.5 billion Medicare expansion program and the $573 million investment in women's health, which could lift diagnostic volumes and service utilisation. However, private health insurance like Medibank and NIB Holdings may face some margin pressures if premium indexation is removed and the public health system becomes more competitive.
Yeah, we'll be watching that closely. But also in the energy and resources space, BHP, Rio Tinto, Woodside, and Santos, they could benefit from the government's $7.3 billion clean energy transition strategy as well. But we also need to keep in mind that industrial relation reforms such as same job, same pay could raise compliance and labour costs within this industry.
And in the automotive space, our B Corp may face some longer-term risks from rising EV adoption under Labor's new fuel efficiency standards, which could lead to less demand for parts for combustion engine vehicles, which is their main demand channel.
And of course, also, Matt, in education, we've got IDP Education. They face short-term uncertainty amid stricter student visa policies, but this appears to be factored into their share price at the moment. And the long-term outlook remains supported by robust international demand.
And within financials, expanded home buyer schemes may support mortgage growth for major banks. Meanwhile, retailers such as Woolworths and Coles may face pressure under anti-price gouging laws. Those stage 3 tax cuts could boost consumer spending and support retail companies like Lovisa, Breville Group, and Super Retail.
Yeah, that's a great summary there, Matt. But at the end of the day, these policies remain uncertain, from the rollout of Medicare reforms to the pace of energy transition and the impact of increased regulatory scrutiny. It's really more important, though, for investors to block out all that political noise, instead focus on what matters most, and that's the underlying fundamentals such as the financial health, past performance metrics, and also the outlook and active risk for these businesses. That's all we have time for today, but thanks, Matt, for your contributions.
My pleasure, Kien. And if you do have any questions, please join us on Monday morning for Lincoln Live.
And everybody, take care and have a happy, healthy, and prosperous week ahead.